Lorraine Leahy with McDonald Realty. I'm here today with Joel Olson of the Joel Olson team. Joel's a mortgage broker and he's here to answer a few questions for us to help guide people when it comes to getting a mortgage for a home. Hi, Joel.
Hi, thanks for having me.
Thanks for joining me today. Mortgages are really daunting for some people, especially first-time home buyers.
Absolutely.
And it's really valuable information before even considering looking for a home to know what's involved in getting a mortgage. It's one of the first things you need to do before even venturing out to look for a house. Absolutely. So my first question to you is, what is the most important thing that people need to think about when it comes to getting a mortgage?
Yeah, so I think, the biggest thing is that people need to realize that getting pre-approved for a mortgage is a cumbersome process. It means we're going to pull your credit. It means we're going to look at all your income documents. We're going to, pretty much get your life story, everything next to getting your next 15 kids promised to us. And really where people run into problems is that we'll hear people all the time go, oh, I'm getting approved with you, but this seems to be different from before. And when I got a pre-approval from another institution or another broker, they didn't require this information. And that becomes a very, very serious error, of course, because what happens is that you end up with a pre-approval that's really not based on, that's really not accurate. It could be way too high or way too low. And remember that the income that we look at, we may determine your income completely different. You may tell us that you may say you make $150,000 a year, but it turns out that is actually seasonal income and we may only be using 90. Or you may tell us you're self-employed and you say, well, I'm usually making 100 grand on my tax returns, but maybe there's a self-employed program that we actually are going to use an income of $200,000. So all those things mean that it's very, very vital that we do a pre-approval, including the entirety of your documents.
Okay, so what you're saying is that there's a lot to go over, and if it's just skimmed over, it doesn't give an accurate profile.
Absolutely. And nothing worse than, going and offering on a home and finding out that, after you've done all this work and fall in love with the house, it's not going to work for you.
Exactly. Yeah, that's unfortunate. And it does happen.
Yeah.
So what about credit score? Can you talk a little bit about that?
Yeah, so generally, regardless of what your credit score is, actually, there's always a loan that exists. So a few things to remember. If we hear all the time, people go, I have the best credit score that anyone's ever seen. I mean, the truth is there is a range of credit scores. And once you hit a certain range of the credit score, it doesn't actually matter so much whether you're 10 points or 20 points up on that or whatever that might be. So really anything above 700, qualifies for almost every program. And most scores, if you have 650 and above, really does qualify for most loan programs out there. We'll look really closely at your actual credit history. Yes, making payments is very important, but also a really big thing that really weighs in your credit score is your utilization of credit. So that means if I have a $10,000 credit card and I'm always at 9,500, or worse still, I'm over the limit, that's going to absolutely make a detrimental effect on my credit score.
Right.
If I have a credit score that's low, even in the 500s, that's still possible, but I just need to realize that's going to be a 20% down payment or a bigger down payment, and use a higher interest rate. Interest rates, when I have a lower credit score, would start at anywhere from 2.5% to as much as 10%, depending on the entirety of the situation. One myth I will say that a lot of people come up with that is a problem is that it is a total myth that if you get your credit pulled more than once, that's going to be the difference between you qualifying and not qualifying. The vast majority of credit pulls are soft pull. They don't affect your score whatsoever. And if you're having your credit pulled for the purpose of getting a mortgage, or for that matter, going out and buying a car, if you're getting a pull for the same reason, it's not going to affect your credit score or bring it down. So you shouldn't be afraid to have your credit score pulled. That's a big thing that can be a problem, because a lot of times when people don't have their credit score pulled, that's going to my first question. Your first question is that there's things on their credit that might be identity theft or incorrect that could mean that they're not going to be qualified for the mortgage, when we could have fixed that if we had more time.
Okay, well, that's really interesting. And so you covered a little bit about debts as well. And so what about debt to income ratio? I'd like to hear a little bit about that.
Right. So, I mean, more and more people ask us, like, what is the income and how much can I how much can I afford? So, I mean, we produce a few different resources as far as some cheat sheets on what people qualify for, but there's really two criteria. When I'm putting less than 20% down on a mortgage, I have to have an insured mortgage by the government. And that debt ratio means that I have to have 44% of my income go towards debt. So that means if I make $1,000 a month, I can have $440 go towards the entirety of my monthly debt payments. If I bought a home, the property taxes divided by 12, a little bit of heating costs, and my mortgage payment. Remembering that my mortgage payment must qualify based on a stress payment. So even though we might be giving you a rate of 1.5%, we're required to assume you're paying a rate of 5.25. That's called the stress test. And then if you, then the other ratio, so that's called the total debt servicing. The other ratio is the gross debt servicing. So that's the total of my housing costs. So my housing costs include my heat, my monthly property tax payment, and my mortgage payment. And those together can be 39% of my income. So if I make $1,000 a month, I have $390 go towards that to qualify. Now, if I put more than 20% down, those ratios are still roughly about, they're roughly 44% across the board, but there's some wiggle room. We could go over that. That's allowed if you have 20% down. So there's some room if you're putting 20% down to fudge those ratios a little bit. And in particular, we can also go a longer amortization of 30 years, which also can mean you can qualify. So a lot more room on that perspective if that happens. But if you're putting less than 20% down, there's absolutely no room for your ratios to go over no matter even one iota.
Right. So generally you can tell people what they can qualify for so that when they go out to look at homes, they know what price range to look in.
Absolutely.
Right.
Absolutely.
Yeah. So they're not going down the wrong track and then find out they don't qualify for that house that they really like.
Yeah.
Right. So it's really important. So does a pre-approval mean that a person is approved for what it is they're going to make an offer on? Because
Right.
we see a lot of these offers now, so no subject offers. And I'm just wondering, are people getting in trouble doing that because they assume because they have a pre-approval that, they're qualified for that particular mortgage?
Right. So, I mean, obviously, like the market is what the market is. And as we see more cash offers out there, people, use that as a competitive advantage. And we know, there's government legislation that appears to be coming down the pipeline that will restrict and put a cooling period into play. But generally, when someone's been pre-approved, that means we've pulled your credit, we've looked at your income, and everything on that end is good. But the property itself is a very big part of the approval. There's a lot of reasons why a property might get turned down. You might buy a home that's too old or has a building defect, or he has a strange way of being zoned, or is close to a power line. There's a lot of reasons why a property could be turned down. We once had a property that had a suite in the very front yard that was a train caboose. And so that was a reason why a lender turned it down. So those can all be reasons why it turned down. So generally, these are individual conversations we'll have with clients, but when someone's coming in unconditional or not going to put a condition, we need to approach a scenario on what if lenders turn down the property, what are we going to do? Now, there's a number of ways we might do that. We might line up some backup financing that's a bit more expensive that you have to be comfortable with in case your property doesn't pass. But then the other thing, of course, is that on you as a borrower is that we're just giving an accurate guess. If your information becomes incorrect, or all of a sudden, you have some effect on your credit or anything like that, your pre-approval could be different. So it's generally not recommended to go with non-subjects, but it is the reality in a lot of markets. We just have to prep you on what that means and what's involved based on your individual circumstances.
Right.
Sometimes we'll get people that have some situations that are very much 50-50. Maybe your credit score is right on the line, or maybe your income, needs an exception. And so we'll prep clients accordingly that, hey, this is something that will happen, or this could still be an issue, or whatever it is. Recently we had a client that, we pre-approved them. And then when they went to get approved, it turned out that they had a repo from 10 years ago, which is not on their credit bureau, but because they had a repo with Scotiabank and we were applying to Scotiabank, that became the reason why they were turned down. And it was actually a repo of a previous relationship, and they didn't even know they're entitled. So there's always strange things like that can happen. But, we just want to, but also we appreciate the market is the market, and, we have to prep people up and just be prepared for those eventualities.
Right. Well, that's quite a bit of information, and it's really helpful for people that are, don't know very much about mortgages, and even people that have had mortgages in the past, because it's always
Sure.
changing. The rules are changing, the banks change how they operate, and so it's always good to keep up to date.
Absolutely. Well, great. Well, yeah, I mean, if we can help with anything else, I'm certainly pleased to. But yeah, that's in a nutshell how a lot of financing works when we're pre-approving people. So
Okay, well, thanks a lot, Joel. Have a good day, and I really appreciate your coming on.
my
Thanks.
pleasure.